welcome to this webinar on how to crack a cap table. So sorry for the late start. We are just waiting for, we just have a couple of technical issues in the green room, but Luke's working through those and sorting them out. So welcome again to the webinar. Hopefully you're joining from somewhere warm because it is a very crispy day here in Tamaki Makaurau. I'm Renee Jamison. I'm the Chief Marketing Officer here at Orchestra, and I'm really excited to be hosting a panel of experts, so very knowledgeable people on this cap table topic. I will introduce them shortly, but before doing that, I thought I would just set the context a little bit. So my background has been technology marketing. I've been working with companies of many different sizes over the course of my time, and most recently with startups, helping them with capital raises. But kind of full disclosure to kick off this conversation, I am not a founder, and I have never raised capital myself before. And so I'm sort of learning. I think I'm in the best position to be able to ask the questions because this session is really around sort of the basics of cap tables when it comes to capital raising. So I will ask the silly ones for you to our experts who are here to provide their advice in this space. So in the last couple of months that I've been working at Orchestra, I've been lucky enough to work with a lot of startups within the community here in New Zealand and in Australia as well. And one of the most common things that we often get asked is around capital raising and what is a cap table. I was recently at Electrify Aotearoa on Tuesday, and that was quite a hot topic for the 500 or so female founders that were in the room at that time. So I don't have a finance degree, and I'm sure many of you on the call don't necessarily have a finance degree either. So that's kind of why we lean on these experts that we have today. So I will just kick off with a little bit of an overview of what the discussion will entail today. So Luke, if you wouldn't mind rolling to the next slide. So we are going to talk about what potential investors are looking to see in your cap table. We're also going to talk about how to present your cap table information in the most effective manner. We'll get into some of the common red flags for investors and how to avoid or manage them. And then we'll talk about some of the crucial reasons why maintaining an accurate and well-structured cap table is essential to your company's success. We do want to leave space at the end for Q&A. So we are lucky enough to have Mike, Andrew, and hopefully Jo, if she can join shortly, on the panel with us as well. So please feel free to utilize their expertise while you've got them through Q&A. So next slide, please, Luke. Just a couple of things before we get started. I need to let you know that obviously this webinar is being recorded as we speak, and it will be available after this session as well. So we'll send that out to those that weren't able to join us. Second caveat is that it is a general education session. So you might have some questions that are specific to your scenario. If we can't get into them, we would recommend that you do seek financial or legal advice. And I know that there are quite a few of those experts on the call as well. And then thirdly, I've already mentioned it, please do ask questions. We want this to be an informative and engaging session for you all. So make sure that you utilize the chat box and the question box that you'll see on the right-hand side within the toolbar. So just before I get into meeting the experts, so Luke Smith, our CEO, he's offered to moderate for me today as well. So he will be sending through any questions to us sort of backstage. So let's crack into it. Here are our panelists. I will let them introduce themselves and maybe go from sort of left to right. So Andrew, do you want to come off mic and introduce yourself and tell us a little bit about your experience with fundraising and cap tables in particular?
Sure, kia ora. I'm Andrew. I'm a venture partner with Matu. We do early stage science and deep tech. And when we say early, some of the companies that we're working with are being incorporated as we're doing due diligence. So you know, super early. And I've led about 5 or 6 investments through Matu over the last couple of years. Have looked at a lot more cap tables, looked at a lot of companies, and sort of picked up on how to make them look okay and how they might come through as not so okay. So yeah, that's my background.
Cool, nice to have you on the call today, Andrew, and I'm sure you've got a lot of insight that you can, and a lot of value that you can add to those that are on the call with us. I don't believe we have Jo yet. I can't see her in the green room, so we might just skip across to Mike. Mike, do you want to come off mute and introduce yourself and your expertise in this field?
Yeah, sure. Hey everyone, I'm Mike. I'm one of the directors and CFO partners here at Oxygen Advisors. We offer outsourced finance services to early stage high growth companies. And yeah, in New Zealand, that's typically software, hardware, or some sort of deep tech. And I've been involved in over 100 million in cap raising of dollars raised, and that's probably across 20 to 25 raises, that number. So yeah, plenty of experience in the space, mostly with early stage, anywhere between pre-seed and Series A.
That's awesome. I'm sure we will gain a lot of insight from your experience. So before we actually jump into the first question, what I thought I would do, something that would be quite helpful for our panelists, is to ask a couple of questions in the poll, just to help us get a sense of what type of company you are and what stage you're at. So the first question is just that, actually, what stage is your company at? So if you can all just jump into the poll. So we've got one advisor so far. That's good to know. Any pre-seed, seed, or growth stage and beyond companies on this call? Nice. We've got one for growth stage and beyond. Any of the earlier stage companies? Oh, cool. We've got one seed. A lot of bigger, more kind of high growth stage companies. That's cool to see. So next question would be, how big is your team? Luke will get this poll live. We've got 10 to 49. There's some of the bigger teams actually on this call. That's cool to see. And then final question before I hand over to Andrew. How confident are you as an individual with your cap table that you have at your company at the moment? So are you very confident? You're super happy with it? Are you somewhat confident but could do with some work, or no, in kind of a similar boat to me actually, so not confident or sure what it should look like, or it doesn't apply? So we've got a few somewhats and a few not confidence at all, so that's good to know. Thank you. All right, so we will take down the poll slides and then jump straight into it. The first question to kick us off, I'll hand over this one to you, Andrew, but can you just start with the basics and explain what a cap table is, what it isn't, and then why is it important for investors like yourself to look at a cap table?
Yeah, sure. So a cap table is important for a couple of reasons. We need to know who owns how much of the company, and this includes folks who might have rights that are not reflected on the official share register. So the share register is what you might find on the Companies Office. It's people who actually own equity that is recognized, that is sort of real. But what we're adding to the cap table is the people who own things that are perhaps on paper. So things like employee share option programs or ESOPs, things like convertible notes or loans, things like other options that would not appear on the company's register essentially, or company's office website essentially. And so this is important because owning part of the company, even if it is just ESOP or a loan, might give those parties particular rights, such as voting in shareholder resolutions. Sometimes that's not the case, so we need to kind of get that detail. We want to see who the parties are on that cap table and whether or not we as an investor think that we can work with them. Having a small number of well-aligned parties can make your life a lot easier when you're trying to make changes to the company, or when you're trying to do things like negotiate a significant contract, or negotiate an acquisition or something like that. And if you've got a lot of parties that include some troublemakers on your cap table, then that can make even the simplest corporate action quite miserable. So that can be something that is positive or negative for investors when looking at a cap table. And probably the most important thing is that owning part of the company means that the parties on that cap table have rights to any financial returns. So that could be dividends, that could be an exit through a listing on a stock exchange, that could be an acquisition. Money's going to flow back to the people who hold something in the company. And we need to know who those parties are, and also make sure that the right parties are the ones that are financially motivated to do everything that they can to make the company successful.
Perfect answer. Thank you. And I see we have Joe. Hey, Joe. Welcome to the webinar. I don't believe we can hear you. It might be a microphone issue. Let's see if you can get that. I don't. It does say you're off mute, so I'm not sure what's happening. There, it could be a settings thing. I know that Andrew had a similar issue actually when he was joining earlier. So maybe check your settings, and then I can do a bit of an intro and then kind of get you into the session. But it's very good timing because I did have a question for you actually. But I will go back to you, Andrew, just because we're sort of talking about this from an investment perspective. And I know it's something that you talked quite a bit about when we caught up. So around any kind of formatting tips that you could provide, like what is the best way to present your cap table? How do you present it well, as in like from an investor's perspective?
Yeah, so it's really helpful to get it in a spreadsheet rather than in like a PDF or something like that, because we probably do want to play around with it and just see what happens if we change certain things. A really well-structured cap table will tell us who is a founder or key person, who is a financial investor, and kind of separate those out or keep them in order. We'll see what types of equity or rights those parties hold. So ordinary versus preference shares, ESOP or convertible notes. And then ultimately what we want to see on the right-hand side is what that fully diluted percentage ownership is for each party. So fully diluted just means including all of those things that don't show up on a share register. And the reason that this is important is it allows us to calculate the impact of a capital raise on that cap table that you're showing us. We can see how much equity is being bought when new investors come in, and therefore how much dilution the existing shareholders will face. And the last thing is that any notes that explain anything that might look abnormal or weird is also really helpful for us, because we're getting a document that may not have much context behind it. We're just getting some numbers. And in most cap tables, there is something weird that probably needs a bit of explaining.
Yeah, really good tip actually. So a spreadsheet, and make sure that it does include notes so that it's sort of self-explanatory when an investor is going through it. That's very handy. Hey, Joe, I might just check in to see if you have managed to sort the microphone. Okay, okay. In that case, I might just hand this one to you as well, Andrew. So when you're thinking about a cap table in the investment process, at what point do you typically, as a founder, need to hand your cap table over to a potential investor?
Yeah, not to steal Joe's thunder here, like pretty early on. And the reason why it needs to come early is because as you're doing your pitch, probably one of the investors is going to the company's office website and having a quick look at what's on there. And that's setting baseline expectations in their mind. And they know that there's going to be extra stuff that's not shown there, but it can already start to set some expectations of, oh, is this a okay looking share register or not? And so I would say like definitely in your data room. But if you have an appendix slide in your pitch, or if you have something in like your information memorandum or something like that, that can show where that what that cap table looks like and give yourself that opportunity to just like explain anything that looks a bit weird, that earlier is probably better.
Okay, that's really good to know. Thank you. And then I guess like a similar question, but more sort of from the opposite perspective, and something that I know most people on this call would be very interested in. But what are some of those kind of red flags that you will look out for when you do see a company's cap table?
Yeah, and maybe some other folks might want to chip in on this as well. A couple of the key ones that I'll look out for. So having key people or founders who are no longer actively involved in the company. You can uncharitably call them dead weight. And if you can, just try to buy them out as early as you can. Otherwise, large equity holding from non-active shareholders. So you might have somebody who's given you a bit of money to get the company started, but they're really not going to be helping much beyond that. And if they happen to hold like 40% of the company, then that's going to potentially be a problem later on. If there are certain investors on the cap table that might have a bad reputation that no one wants to deal with, I've certainly seen that happen a lot a couple of years ago when there was a particularly investor that was known for having a troublesome director that would just like make everybody's lives difficult. And as soon as you saw that investor on a cap table, you just be like, no, I don't want to deal with that. Thankfully, they're not that active anymore. And then probably most important is like the founders and key people not having enough equity. And the key challenge here is at some point, if you're looking for investment from international investors, let's say at your Series A or Series B, they will have certain expectations for how much equity the founders or key people have. It varies like by what area you're working in. So SaaS companies are very different to like pharmaceutical companies, but it can be as high as like 50 or 60%. That expectation that the founders and key people have that. And if you don't have that, then those investors will just say, no, the cap table's screwed, we're not going to invest. So you could be shooting yourself in the foot now by investing in a company that has already blown past that. So from an investor perspective, earlier, we need to kind of make sure that we're not setting ourselves up for failure at a later round.
Yeah. Okay. So you'd definitely sort of look for different, depending on the stage of the company and what raise they are doing, you'd look at what the equity percentage across founders and then other kind of key stakeholders looks like and make a call around that, or potentially send a cap table back if it's not necessarily where it needs to be, and kind of manage that process. Yeah. So Mike, I might actually hand over to you now, and we can come back to Joe, or I might just check in with Joe actually. Can you hear us okay? And can we hear you?
Hey, just before you move, excuse me, Renee, to the next part, just a follow-up question, Andrew, and Mike, you might be able to weigh into this as well, is from Trevor around, given the high dilution expected in deep tech, what does a typical founder equity percentage post Series A look like? What feels like market?
Yeah, but no one ever really wants to like put a stake in the sand because it's all quite variable and it does really depend a lot on specifically what sector. As a very rough rule of thumb, we try to make it so that the key people who are active in the company should have about 50% equity in the company after the Series A. Not always possible. And I think if you're like 45%, nobody's going to complain too much. But you really want to try and get to that 50% mark if you can.
Yeah, it's that 50 to 60% for a Series A is pretty common, and but probably the benchmark is somewhere in the 40s, right? Because there's lots of examples where people have funny cap tables and wind up with lower percentages, and investors might look past that depending on how excited or in love they are with the, or how deep is the deep tech. Maybe they had to consume a lot of capital to get to the Series A.
Yeah, something that I'll just quickly add is that I keep saying key people, so that it's not just the founders, it's also just other people who are like in management. And something that is often missed is that you should add the ESOP percentage to that number to calculate whether or not you're at that 50, 60% mark.
As in, so consider the ESOP as like fully vested in what that looks like.
Yeah, in a fully diluted sense. So, the founders may actually only have 30% on like on the share register. But if we know that there's actually a 20% ESOP on top of that, then maybe everything's okay.
Yeah, and across some of the other leadership too. Okay, that's really interesting.
Hey,
Mike, I've got
that is interesting. And sorry, Renee, just on that point, another one from Denisa is, will investors be happy with the founder having ESOP if the founder's not able to buy more ordinary shares to get up to that level, I guess?
The short answer is yes. Yep. That's not uncommon.
Yeah, to get founders back up to a reasonable ownership percentage, you do see it fairly often. Obviously, there's some tax disadvantage for the founder in that scenario. So if there's ways to give them actual shares, it's often beneficial. But there's plenty of situations where it's basically not possible to do that, or you can't do it without paying a massive tax bill, and so ESOP winds up being the mechanism.
Right. Okay. Hey, I might just flip the conversation more towards you, Mike, and your experience being a CFO. Like you mentioned in your introduction, you've worked with many different high growth companies, and you've been involved in many different capital raises. So, from a founder's perspective, can you talk us through a little bit more around the do's and don'ts when it comes to presenting your cap table to investors?
Yeah, cool. I mean, Andrew touched on quite a few of them. But yeah, it's showing your cap table in the cleanest way possible is probably a big one from a founder perspective. Things I'm thinking about there are if you have a massive long list of shareholders, if you can consolidate them into some sort of nominee structure, that's always quite nice, especially if there's like 10 plus shareholders or maybe 20 plus shareholders with all 2% or less. Like makes sense for them to probably all be grouped up into a nominee structure. And I know Ice House do that for free, I think. Might be wrong, Joe, probably be able to comment. Other things is like people do have historic just quirks in their cap tables. You know, like not every company was founded just straight by the founders and then had the typical VC investment path put into it. And so where you can simplify, if there's going to be secondaries or something interesting happening around the raise, if you can make it easy for the investors to understand when they invest, what the cap table will look like. So almost like, okay, we have a strange looking cap table, but post raise, this is how it will look. I think that goes a long way as well, because at the end of the day, an investor wants to know what ownership stake they can get and who else is going to be there with them post investment. They don't necessarily need to know exactly how the sausage is made.
Fair enough. And so thinking about some of the earlier stage companies that we have on the call, so you'll already have a cap table set up in some way, whether that's like on the back of the napkin or within your head. But can you talk about why it's important for you to sort of establish a cap table very early on and have it in a format that's manageable and can be adapted over time?
Yeah, for sure. I mean, you legally have to have a share register, which is probably a lot of the information that would be in the cap table anyway. So that's legal requirements straight away. But then also knowing your ownership percentage, knowing, you know, we talked a bit about when you get to Series A, Series B, whatever, what ownership stake you'll have and what key people will have in the business. The only way that you can actually know that is having the cap table today and then saying, okay, well, if we raise another round at this valuation in the future, this is what the equity percentages will look like. So yeah, it just gives you a broad sense of what your actual ownership in the business is, and you really the key thing that's also been touched on already is that the key people need to be incentivized long term to grow the business, and that's why investors want to see key people have good ownership, because they know they'll drive for a good outcome, that the incentives are aligned. And yeah, having a nice cap table that you can easily refer to if an investor comes in, you can show them quickly. Like, just is really handy to have on hand.
Mm-hmm. Cool, perfect. Yeah, and you're right. Like share registry is a legal document, but it's really helpful, I think, for founders to think about what that scenario modeling looks like, especially when you think about some of those unissued shares. So that could be in the form of ESOP or warrants or convertible and safe notes. So I might just talk about that more specifically as it relates to ESOP, or for those of you that aren't familiar with an ESOP, so it's an employee share options plan. And so typically when a company is raising money, they will allocate an ESOP pool for their company. And so that is basically a way for them to distribute equity or ownership to their employees. And that's important because it does create that ownership mindset within a company. And if a person that works in the company has a stake in the success, then they're obviously going to make the right decisions around making sure that that company is successful. So that ESOP pool that is allocated is a group of unvested shares, which are shares that are not yet issued, and they will vest over time, but it doesn't necessarily mean that they are issued when they're vested. So the employee has the right to exercise those shares, and once they do decide to exercise those shares, that's when they become shares that are issued. So when you think about that and I know we've sort of talked about it, and Andrew, you touched on this at the beginning, but when you think about that scenario modeling and that the dilution component, like what role does ESOP play in that, and what are some of the tips and tricks that you could advise these founders around how to structure ESOP pools, especially at different stages and different raises of the company? I might just kind of throw that out there, and I don't know, Joe, are you? Yeah, it's still not working. I don't know why, because you are off mute. We can see you talking. I might have to throw back to Andrew, I'm sorry. Andrew, would you mind talking us through, like, from an investor perspective around dilution, especially when you think about sort of allocating ESOP across your company?
Yeah, I think it does come down to who your investors are and what their philosophies are around ESOP. You're going to get some investors who just like hate being diluted and they want as little ESOP on the cap table as possible, and that's probably not actually a good approach. But you've got some investors who prefer that. There are others who will say, well, yeah, we totally get that key people need to be incentivized. I think another challenging thing is that there are quite varied expectations between sectors and between geographies. So obviously when you start like Googling ESOPs and you go online and stuff, everything you read is going to be from Silicon Valley. And just because it's how it's done in Silicon Valley doesn't mean that it's necessarily how it's done here. And just because this is how it's done in SaaS doesn't mean that it's how it's going to work in deep tech. So it is important to make sure that you are like benchmarking against the right things in terms of what is normal. But otherwise, beyond that, I mean, I think an ESOP pool is the reason why before I was sort of hinting at, relatively large ESOP pools is because it is sometimes used as a mechanism to try and get the founders back to the level of equity that they should have in order to be able to successfully raise capital later on. And it's a nicer way of rebalancing the cap table than to do what is called a recapitalization. You say recapitalization and everybody starts getting really nervous and it's like, we don't want to talk about that. If you have an ESOP and you just like make it 20% instead of 15% or 15% instead of 10%, then like everybody can kind of live with that a little bit more easily. So I mean, as far as like the cap table itself is concerned, all we really need to see is how big the ESOP is. Separately, we can get another document that says how that ESOP is allocated and who gets how much and who gets what and that sort of thing. Well, actually, no, I think to slightly correct that, if you do have ESOP that's allocated to the founder, or the founders, we probably do need to see how much of the ESOP is going to them versus everybody else in the team. But if your ESOP is entirely just going to like other team members, then we'll just kind of go, okay, that's all one group together, and kind of look into that detail separately later on.
Right. Okay. And so you kind of touched on it at the beginning of your answer then. So ESOP compared to like Silicon Valley or where they do kind of like stock option plans. So it's not as common yet in New Zealand. It's probably more common within sort of like the startup community across like SaaS and deep tech. How do you establish what those benchmarks look like when it comes to ESOP grants and pools?
Yeah, it is a bit tricky. It is, you have to work with your investors on this, and other advisors. I mean, you talk to your lawyers and accountants who will hopefully have seen like hundreds of these and have a good sense of what is normal in New Zealand. But yeah, like I said, it's up to like what your investors consider to be acceptable. And it's at the end of the day, like values alignment around whether or not they agree with the purpose of that ESOP and, what are you actually using it for? You can take some inspiration and information from, online in Silicon Valley and that sort of thing. But yeah, it's no replacement for talking to other founders and seeing what they've done in New Zealand, and B, just like getting good advice from professionals like Mike.
Yeah. Mike, do you have anything to add to that one?
Yeah, I mean, Andrew's 100% right. But yeah, I'd say typical ESOP pools in New Zealand range from 5 to 15%, and probably like the most common is something like 10% that's established ahead of the first VC raise or first professional investor raise. It does vary though, like, some companies have a 30% ESOP pool and some have none. So there's and that those kind of situations really depend on the founder group, the investors, and the other circumstances surrounding the company and the raise. One thing I'd say on ESOP is what I do see happen quite often is that if you've got a small pool, like a 5% pool or something on the smaller end, and that's kind of what the investors are comfortable with, and that's what you want to maintain, is one, just being precious about how you allocate it out, and two, making sure there's some sort of expiry or there's mechanisms around how that ends, because if some companies go through multiple pivots and have a not just that straight VC path, it might be quite bumpy getting there. And in those situations, the employees that were with you, say 5 years ago, that were there for a year, and now the company is doing something completely different and has had to raise money from different people and has gone through a few iterations, you kind of don't want them clogging up your ESOP pool at that point. And so that would be a fair time to have, like, they either needed to vest and exercise their shares when they left, or not all those options expired.
Yeah. Do you have any recommendations just on that expiry, particularly for early stage? Like what is common in terms of expiry date for early ESOP?
Pools? I think it does. Again, it varies based on your ethos around this. Like, some people will say, fair enough, you have 5 years to exercise, because when you do exercise that ESOP, there's a personal tax implication, and if there's no exit or liquidity event, then you have to pay that tax without any income to pay it with, and so that's always a bit tough. Other people just make it 30, 60 days after leaving the company. You have to exercise your options or they expire. And then some people don't put an expiry on them, but I really wouldn't recommend that. If everything goes to plan, it's no big deal if there's no expiry. But if I'd say 90+% of the time everything doesn't go to plan, and having an expiry would have been nice, even if it was 5 years. And I've seen 10-year expiry in there, but for a lot of startups, like, the plan is to exit within 10 years, and so the expiry is kind of moot at that point.
Yeah, totally.
Yeah,
thank you for that advice. Mm-hmm.
I just say that our standard is 10 years expiry or within 60 days after leaving the company. And the reason why we have the 10 years is because deep tech takes longer than SaaS.
Yeah. Totally.
Yeah.
You still have the 30 or 60 days post leaving the company, and I think that's the key distinction, where there's not the 30, 60, 90 days leaving the company expiry, but there is but it's 10 years, or there's no expiry. That's where you get into these problems where people from a long time back have material portions of the ESOP pool, and you can't, and it's just it just creates complexity. We talked about clean cap tables earlier. You're then trying to buy them out with some sort of debt product or something, and it's a massive headache.
Yeah, or through like secondary shares or something like that, it does become a bit complicated kind of quickly, especially if they aren't there helping the company grow over the 8 years that it has been. That's really good advice. So I think we're sort of 33 minutes into the discussion, so I might just encourage anybody on this call to submit their questions through, and we will get to that shortly. But one final question, and it sort of relates to company valuations, but when you think about cap table, what role does a cap table play in determining the company valuations during funding rounds? And so, like, how can founders in particular strike that right balance between attracting investments and making their capital raise attractive to investors, but also thinking about how they maintain that ownership? So happy for either of you to kind of take that one.
I mean, I think maintaining your ownership, the best thing you can do is have a competitive process for your raise and get multiple interested. It's like selling a house or something, like any sales process. If you have multiple interested parties, and hopefully your company's awesome, and there are multiple interested parties, that they will, that pushes the price up and gets you a fair market valuation. Whereas if you're just, if you're relying on one investor, you kind of are, if they choose to only offer you a low valuation, you're kind of without any other options to take that valuation. So having a competitive process is important. And the other thing is, when you go to raise money later, if your existing shareholders are not going to be able to fund the full journey of the company, which is really common in New Zealand, like a lot of investors specialize in a certain part of the company life cycle, then investors should know that at some point, like, they'll need to raise money from elsewhere, and the founder's equity position will be important. So I guess it just helps with that conversation around taking a heap of dilution and then the investors promising to fix it later when you go to do that raise is a little bit risky. You almost want to have that conversation a bit earlier when you're doing that round, saying, I can't get diluted to 20% pre-Series A because we're going to really struggle to raise capital, and I'm not going to be motivated to take this company to unicorn status, billion-dollar valuation. So yeah, I guess being armed with the knowledge when you go into those conversations is key.
Yeah, I think on that last point, it does come down to how experienced your investors are and like how responsible they are, because you will find some investors that are just like trying to get the best possible deal for themselves, but they're really actually just making their own lives more difficult because their companies aren't going to be able to raise capital later on, and then they might hold 50% of something, but it'll be 50% of nothing. So it's not actually good for them to do it that way. I think to the original question as well, I think it comes a lot down to whether or not the investors that you're talking to, are they looking for opportunity or are they looking for like reasons to say no? It's a mix of both. And when you're pitching, you're trying to get the investors excited about the market opportunity and the technology or product that you have and so on and so forth. And you're trying to get them excited about wanting to invest in the company. So that's what leads to that competitive tension of having multiple people put in term sheets. But there are lots of investors who are, sitting through every pitch just trying to pick holes and figure out reasons why they shouldn't invest in the company. And I would say that like a good cap table is expected, like it's a given. And if you have a bad cap table, that's a reason for somebody to say no, rather than like if you have a good cap table, it's a reason for somebody to say yes.
Yeah, so it instills that confidence like right from the get-go, rather than like if you have to send it back, that's already probably a bit of a red flag for an investor. Yeah, really good point. So I know that there's a few questions, I can see them kind of popping up, so I might just hand over to you, Luke, to send some of those through for Mike and Andrew.
Yeah, cool. There's one. I'll start with Christine's, and sorry, I'm losing my voice, and it's a real shame. Unfortunately, somehow we couldn't get Joe's mic working, so real bummer that she couldn't join, because her input would have been great, but you guys have done a fab job of keeping the conversation going. Really interesting points. So from Christine, it's, can you show a cap table compared to a share register table? Andrew, we've been working on and Mike, you had a little look at a template we've done, which I could share that link, Christine, but I'll let you guys handle the question there, and then I've got a follow-up to that.
Well, it's not exactly, I don't have one that we prepared earlier because I only have cap tables with real names and numbers in them, and can't really disclose those. But essentially, a share register is just the people who own shares. And it would match exactly what's on the Companies Office, hopefully, assuming that your Companies Office data is up to date. The cap table is including ESOP, options, warrants, all of these other things that are just on paper, and what they would convert to in terms of shares based on a particular valuation or based on a price per share, so that you can calculate that fully diluted percentage holding. That's I think the key thing that you would get out of a cap table that doesn't appear on a share register. But if you have a look at Luke's link there, it might give you an idea of the differences between or how a cap table is a little bit more sophisticated. Anything to add, Mike?
Yeah, I mean that's pretty much it. It's I'd use that as the cap table. Probably quite a lot of the listeners here are Orchestra users as well, and Orchestra actually makes because I'm doing a little pitch for you guys, but it share registers for you as part of the product, and so that's really handy. But your lawyers will also be able to set up a share register for you. But exactly as Andrew said, just anything that's not pure equity will be disclosed in the cap table, not in the share register.
Thanks for the plug, Mike.
And thanks for the plug, Mike. I guess a bit of a detailed question, Andrew. You were talking about it earlier, where it's good when you're presenting your table to group different types of investors. So there might be founders, active, inactive, and then you've got ESOP. Mike, you were talking about bundling small investors into a holding company. Like when I'm giving the cap table for the first time to a prospect investor, do I provide that detail in separate sheets, or do I just group it and hold off on that level of detail until they ask for it?
You probably should front foot it and provide the detail where you can. So if you have like a nominee, for example, you could have a different sheet that says who's in that nominee.
Okay. Yeah, so you're going to want to dive into it, even though, you know, like I get the point, like make it simple and group it, but I'm going to want to go through the details, so provide it somewhere. Yeah.
Sometimes it's not possible. So for example, if your nominee is a Angel Club nominee, who's behind that Angel Club nominee is probably not known to the company, and therefore not known to investors either, and that's okay. Like if it's an Angel Club nominee, then we kind of just accept that that's who it is, and we're not going to ask too many questions. But if you've created your own nominee and you've got like 10 different investors in there, and they're actually all professional investors or something, yeah, we probably want to have a look at that list to go, oh, hold on a minute, there's a troublemaker that we know that's, you know, that they're going to cause a fuss. That's detail that we don't want to be like surprised by, you know, 3 weeks later on when that investor pops up and is like, hold on, you know, I want this, I want that.
Yeah, great. Hey, we've got a good question here. So I'll just read it out. Working backwards from your dream exit scenario for your company, what's the best source for developing a cap table model, you know, for your business before you even start down the road of capital raising? I guess, you know, so you have a really clear plan before you embark on your first raise. I think that's, Andrew, we were talking a little bit about this. It feels like the difference between a cap table, like we're talking about, like this is what it looks like today with maybe a raise scenario, which is pretty static, with a waterfall scenario plan of what the multiple rounds might look like. So I guess, yeah, how do you see, like, what is a founder, what should they be doing? Who should they be talking to? How would they go about that?
Yeah, so this is what we would call a cap strategy, or a cap strategy plan. And if I just start from what investors do, like we will produce one of these regardless of whether or not the founders have, right? So we'll take the cap table as it is today, we'll add on the raise that we're talking about right now, and we'll probably try to model it through to exit. So we'll take a guess and say, okay, well, we think that there's going to be 3 more raises. We guess that it might be at these sorts of valuations, that the company might need this type of money at each of those rounds. And we can say, well, we think we'll put in this amount of money at each of those rounds. So we have a sense of how much we need to budget. If this company is successful, you know, how much more money is it going to need? But then we'll put in, you know, other investors and just say, Series A investors will put in $10 million, Series B investors will put in $20 million or whatever it is. And we can model that all the way through. And if we have an idea of what the potential exit is, then we can say, okay, well, based on the fully diluted holdings at that point in time, this is what the dollar amount is. And that allows us to go backwards and say, okay, well, given the amount of money that we've put in, this is our ROI, this is our IRR, you know, all of those financial metrics that effectively allow you to calculate what the return looks like. So that's what the investors are doing. There's no reason why a founder shouldn't do the same thing. The only caveat that I put in all of that is that it's all based on a bunch of assumptions that are all going to be wrong. And you know, we can kind of get a sense of ballpark, and kind of go, yeah, we think that this is what a journey might look like, but we all know that it's just entirely going to be wrong. So you know, don't go buying a boat on the basis of your expectation that you're going to make it big at the exit 7 years from now. Wait for that to actually happen before you put down the deposit.
Good advice. Very good advice. Hey, I think are we done with questions, Luke? I might just ask one more question for the team before.
I guess I was just keen to hear from Mike as well, sort of how he's like, you know, who's playing that role, how much hand holding needs to happen. Yeah,
I mean, but I've seen plenty of founders do exactly what Andrew described. They create, like, you know, they create the multiple scenarios, and like that there's the link there to the orchestra template, but yeah, you probably have multiple rounds after that, and you come up with your capital strategy. And for a lot of people, capital strategy doesn't just involve equity, so you might sort of think about how much funds you probably need to reach this point, and then how you get those funds, because a lot of, like, especially a lot more advanced, like as you get more advanced with the company life cycle, debt becomes a piece of that as well. yeah, so capital strategy, you kind of, it's all, you want to know ownership percentage, where that gets you to, and then how you fund it. Those are the key questions. And one of those sort of scenario tables definitely is useful in understanding that. And yeah, like talk to an advisor if you there's a lot of resources online, but if you're struggling to figure it out, I'm sure any good advisor will be able to help you there as well.
Very good. And speaking of advice, so Andrew's has been don't buy a boat. No, I'm kidding. I think the last question that I have for you both, just to kind of wrap up this call, would be like if you could give one piece of like really strong advice to everybody that has listened today around structuring cap tables and capital raising, what would that be? I'll start with you, Mike. Yeah.
Yeah, sure. I think probably having an idea of kind of what you want out of the journey of your company is like it's great to do that thinking up front, because that can frame it can frame like how you approach different decisions along the way. There is, whenever you read something online, probably the typical, like you'll read about what's considered the typical pathway for a VC backed like startup. A lot of people will be happy exiting once they're at 10 million, getting acquired or something in revenue, and exiting for $80 million while they still hold 50% of the company. Like, still a pretty good result for a founder. So sort of thinking about what would be a good outcome for you beforehand is really valuable going into a raise. Like, a lot of people go into a raise and they have to raise money because that's the only option. But there are other options out there as well. So I think, yeah, having an idea of what you want out of it is key going into it. And if it is the like traditional unicorn pathway, whatever it is, then that's all good as well. And there's, yeah, like I said, there's lots of good resources on how you tackle that.
Yeah, perfect. Thank you for that. And how about you, Andrew?
Yeah, I have one that is kind of repeating what I said before, and then a slightly different one. You know, if your cap table looks quite different to what's on the company's office, or you know what's on the company's office looks weird, and you have an explanation for it, front foot it in your pitch or investment documentation. Don't wait for an investor to ask about it, because they might not ask about it. They might just jump to conclusions. So do front foot that. And my main piece of advice is that, like, startup companies are faced with all sorts of risk, you know, technology, product, customers, markets, competition, regulatory, IP, team, etc. The cap table is like one of those things that is actually entirely human constructed and largely within your control. So if everything else in your company is going well and in the right direction, it seems like daft to let the cap table be the barrier that stops your company from succeeding. So don't let it be the thing that stops your company from succeeding.
Yeah, let's write that one down. Okay, thank you so much to you both for joining us today. And it was a real shame that Jo couldn't make it. I'm sure she would have had so much wisdom to share with us on this call too, knowing that she's from Icehouse and she sees a lot of cap tables, and I'm sure potentially sends a lot back too. So yeah, thank you to all of those that came along to the session as well. I hope that you found this very helpful and got some good insights into how you form a cap table with your company, whether that you have an existing company or whether you're about to start a new company. So yeah, I'll leave it there. This recording will be available after the fact as well, and I'll make sure that I send it around. So yes, thank you all and have a wonderful afternoon.